Sold at 560.
785 the first, 785 the second, be sure, 785 the third, the final time, sold. The third and final time at £910,000, sold. Well, welcome, ladies and gents, to the latest edition of the All Stock Prop Chat. My name's George Walker. I'm joined today by three esteemed colleagues from the auction world and our head of research. So we're going to discuss today an informed view of the commercial and residential auction market as we head into 2026. Why informed? Well, we've been doing this for 60 years. We sold £900 million of assets last year, and we got our two top auctioneers in Will Clough and Rich Adamson, and the Allsop Head of Research, Seb Verity. So at the end of the pod, as always, we're going to challenge our panellists with how would you invest £5 million in your market to build a medium-term growth. It's always quite fun, and no one ever agrees. And also, what could happen this year if we were to be really positive? So anyway, let me introduce, first of all, Will Clough. Elevator pitch from Will. Morning.
Morning, George. Hi, everyone. Nice to see you. As you say, auctioneer in the commercial team, and grateful that we had a shift to the live streaming in the back end of last year.
That was fun.
So it was nice to get back on the rostrum. Richard and his team have obviously been doing it for a while, and we felt the time was right. The auctioneer side of it is back.
Yeah, it was good fun. It's quite. I think the whole team quite like that.
It was a bit of a buzz, wasn't it? And a great auction, which always helps.
Yeah, the first auction was good fun.
And a nice run in over the summer, get things going. Richard and his team had laid the groundwork in how to do it, and it was dusting off the gavel and relearning the skills.
And bringing in a new auctioneer.
And bringing in a new auctioneer from Yorkshire, of all places.
From Yorkshire.
It's like riding a bike, though, isn't it?
It is.
Well, I shouldn't say you fell off your bike, didn't you, just before the auction? You really hurt yourself.
The night before, took a little tumble.
It's not like riding
but it was
a
a
bike.
Ferrari, so it's fine.
It's far safer than riding a bike.
So, Rich, quick intro from Richard.
Yeah, Richard Adamson. This is my 25th year I'm entering into.
Really?
At Allsop, yeah. So, and I've been an auctioneer for almost 20 years of that, I would have thought. And I have the great honour of being the residential managing partner as well. So, I mean, it's been a whirlwind of a year again. You know, we had 11 auctions last year. So almost one a month, and we've got one a month exactly this year.
You're up to 12 next year.
Up to 12, so it's coming thick and fast.
Oh, Clough, we're sticking to 8.
We're 8 this year, as we have been for the past few,
Yeah, okay. 12's a lot, but it's needed. With the volumes you're dealing with, you have to have them.
Absolutely is, yeah. So much has changed and been forced on the auction market in terms of technology and COVID and getting online and all the rest of it. And that has actually allowed us to have more auctions. You're not waiting for catalogues to print, be posted out, sent out, booking venues, all the rest of it. And coupled with that, we've got so many sellers that are really, really date-driven. So you need to put on as many as you can to suit their needs of disposal.
And we're going to come to discuss the difference between commercial and resi, where the stock's coming from very shortly. But let us not delay. Seb Verity, Head of Research at Allsops. You've been with us some time, Seb, keeping us up to date.
Oh, it's been with 3 years now.
It's 3 years?
Yeah.
Brilliant.
And it's been a very interesting 3 years as well. It's not exactly quiet.
And you initially had a resi brief, but you're pretty much now across the business.
I try and do everything now.
Everything.
Yeah. Research, data, consultancy.
So, Rich, we talked about, just briefly, what have we done in terms of numbers? You've had a very busy year, another record year, I believe.
Yeah, it's been a really 2025 has been an exceptional year again for us in terms of the hard numbers, £550 million worth of sales, which is big for us, it's very big, and around 1,800 properties sold under the hammer during that period over 11 auctions. So it's attritional, it's month to month. But as I said before, it's demand. There is a demand for it, and there are plenty of sellers in a very challenging market that still need to sell.
Yeah, and that's the big difference. And so, Cloughy, our numbers, so I'm in the commercial auction team as well, in case you don't know. Cloughy, our numbers over...
We're just over 350 million and about 520 lots. So massively reduced in terms of the volumes of sales.
It's about
but it's a higher average lot size. Yeah, and I think we've seen some great positives through the year, but we can stand here now on the 8th of January, whatever we say. It wasn't the easiest of years. It had its challenges in the commercial sector because our world is more discretionary, I think.
Yeah. And I think we've talked about this before, but the difference between, if you've got 100 residential properties you want to sell, it's date-driven, Richard, isn't it? It's very different to commercial, which has got a lease running.
It is. There are so many similarities in both our markets and the profiles sometimes in different markets of the sellers and the buyers, and they do cross over more than they ever have done in my career in terms of buyers buying in both sectors. However, I think when you look at the performance of the residential market at Allsop in the past 12 months and compare it to commercial, there are some real obvious signs there that you've got sellers that need to sell. So, for instance, in 2024, housing associations were selling roughly 12% of our catalogue. That, in the year that's just gone, is now 26%, more than a quarter of our catalogue.
That's pretty much, it's more than doubled.
Correct, yeah, it has. And then you look at the private investors, property companies, together it's been about 35% year on year. So that's just stayed pretty static for those that are wanting to sell. So that's the real trend. And the same with receivers. Receivers last year, in 2024, I should say, was like 12, 13%. That's now up to 30%.
Is it really?
From the years it's gone. So
that's so different to us.
And that's something that we've been speaking to the same receivers with the same relationships, and the commercial was always coming. But it's just differently structured. We see so little of that, and I think who our sellers are contrasting to that is it's probably the private propcos, private investors are still leagues ahead of everyone else. We've had corporate sellers, as we've had for a long time.
We've still had the Tesco's and the Farm Foods
and the funeral partners and the NHS and all those sort of things, but not in the volumes of previously, and we haven't had the bulk vendors that you've seen that have pushed it off. And our biggest problem, as always, is stock.
Yeah, we've got the buyers lining
up. I mean, the truth of it, that's a good point you make there, is if you took out of the market for the past 2 years, housing associations and the funds and REITs we've been selling for, we have very similar numbers of volume.
Yeah, sure.
And that is just the nature of what's happening in the resi market at the moment.
And Rich, is that allied to some of the lower quality properties struggling to be compliant? And everyone talks about the buy-to-let market. It's slightly different, but people are worried about compliance and tax rates and FIDOs. Is this what's driving these people to sell, or do they just need to raise the money, or where's that?
Well, it's a mixture of both, but you're right. I think that's the big difference that we're really seeing in our market is the sellers that don't have the appetite or the pockets to bring their properties up to the standards that are now required. Yeah. And that was talked about a lot of last year. Well, it's been talked about for a couple of years. Back end of last year, it became a real issue for some people. And that goes from small accidental landlords, small investors, to big funds that had set up 10 years ago to buy a lot of resi properties. So we haven't got the appetite for it anymore.
Really? Even the funds?
Well, also, but also with the protection of tenants as well, the ability to get tenants out becoming harder. All these things are actually going against some of those landlords, whether they be small privates or really big landlords. And therefore, some of them took the view, we either want to get out or we want to reduce our holdings in that sector. Then you look at the housing associations as well. They were looking at a lot of their stock saying, well, typically they would refurbish some of their stock depending on how much that capex was going to be for each property. It's more expensive to refurb now. So the thresholds probably haven't changed a lot. So actually most of them in their book is obsolete. They did a lot of developing over the past 10 years. Some of them got cladding problems. They took a lot of debt in the past 10 years. Interest rates have gone up. So they're needing those monies to come in.
It's a bit of a scramble for cash, isn't it? For capital.
Exactly that. And the quickest way, most transparent way for them to do that is to use our auctions.
Yeah.
Obsolescence is that unifying theme across all sectors that's driving everything. It's the big structural factor.
When we first talked, Seb, I remember you talking about the Victorian terrace house is obsolete. I mean, it's been around forever. The Victorian terrace house in good nick is not obsolete as we see it now, but it's become a factor in the market, hasn't it? And obsolescence has taken on a different shape. Our busiest ever podcast originally was EPCs. Oh my God, what's an EPC? Now it's a whole raft of different things, isn't it? It's had its shadow on the market.
Yeah, I mean, your Victorian terrace was the last big mass building boom. And if you're using it, looking just singular, a red brick, its material lifespan is 100 to 125 years just because it's clay, baked, so it's going to start letting water in at some point. All that stuff that was built 100 years ago is kind of at that tipping point now is, well, how long can you keep a brick watertight for? Well, it's a big problem in resi. And then when you start layering all the government regulation around the new EPCs, domestic EPCs themselves, which we don't quite yet know what they're going to look like, pretty much people are pricing in minimum B by 2030.
When's the new level of regulation coming in?
They did a consultation on domestic EPCs last year. It's going to be far more complex and multi-layered. There's probably going to be 3 or 4 sort of mandatory factors that get scored for
Is this
resi.
part of the government's great drive for growth?
Yeah, it's alongside the Department for Energy and Net Zero push as well. So that's all linked in. But I think it's starting to be priced in by lenders now, certainly in resi. They're looking at sort of 2030, 2035 and that decent PRS home standard. Within the next decade, we are going to have hard and fast thresholds for asset quality on this basis. And in which case, well, you now people are now looking at portfolios and go, well, hang on a minute, where do these sit here? And do we have to start thinking about remediating or removing that from
our
book?
Capital. So look, we're not here to just talk about compliance. No. So economic overview, 2025 wasn't great.
No. It was an ordinary year that started to slide towards the kind of the depressed, I think, by the end. Yeah. I mean, the budget could have been worse. I think everyone expected it was going to be worse than perhaps it was.
amazing spin, wasn't
Which was intended, I guess. Wasn't it?
I think it probably was, and they did it as well. The previous budget with all the capital gains tax of trade, and everyone going, "Oh, phew, actually wasn't that bad." What happened last time round is that we did see a bump in inflation in sort of March, April when we got the minimum wage increase, and national insurance contribution stuff came in, and that did kick inflation up at the start of this year. In theory, that might happen again a little bit, but it might be offset by some of the other budgetary measures. So the real question is, as of March, April, will we see a bump in inflation again, which is sliding? And that is the good news, is inflation
is falling.
It is falling, yeah, and that should continue. And the question is, will we get to 2% quick enough next year to get rates back down to 3 or below? Maybe.
I would have thought in my uninformed way that if we can get rates below 3, that's what we're not expecting, and that should give us an extra boost.
That would be lovely. Another 50 bips off base rate would, I think, move the dial on quite a lot.
So, and how quickly is that coming?
So once you start layering in GDP and the jobs market, the bank might look at its remit and go, well, actually, I know it's not officially on the docket like the Fed, but we need to also help the Chancellor and the economy along here. The bank are divided sort of pretty much evenly, with the governor being the casting vote. Some of them think that there's not enough evidence that labour market and so on is sliding fast enough. Some of them are convinced that it is and actually want to cut more again. I think 50-50 for a March cut. It's where people are thinking
in February, but 50 in March.
I was saying I thought they'd do 50 bits in February and not cut in December, because pre-Christmas felt a little bit too proactive for the Bank of England. But they didn't. It helped the day before the CPI fell by as much as it was, slowed by as much as it did.
And that was a surprise.
That was
so. Help me here, because I'm not an economist. Cloughy and I work in the yielding market, which is why probably borrowing rates is more important. We kind of hanker after lower rates. But does that mean the economy is slower at the same time? Because we're wanting inflation to come down. So are these things, if actually we do get our sub 3% base rate in 12 months, does that mean the economy is going to be even more quiet than it possibly might be at the moment?
Yeah, it's a double-edged sword, isn't it? It's not necessarily a good sign if the bank has to cut harder and faster, because it would suggest the rest of the economy is not doing as well. Equally, bank base rates not necessarily as closely linked these days as it used to be to your 5-year swaps on your rate. So you would hope to have that closer to 3. And that has fallen. I mean, it's now at 3.5 broadly for a 5-year swap.
Yeah, and it's dropped 20% a year.
Exactly.
In a year, that's a big step.
And this is obviously where the impact of the US starts to kick into our markets as well. What's happening over the pond? How much money are they looking to invest, and at what pricing?
Or print.
And now, again, they have not just stopped quantitative tightening, they are starting to do QE light. So the Fed is starting to slightly to open the taps in the US. That will have an impact positively for us potentially. So these things are easy.
It'll help us,
It helps sentiment as well, crucially.
Yeah.
And relatively speaking, there's what else are you investing in right now? Well, oil. I mean, Brent crude's down 20% year on year. With Venezuela sort of reopening its oil markets in the next 6 to 12 months, that's going to slide the oil price.
Keeping into the world where our guys are investing.
Sure.
Your government debt is quite a high rating at the moment. If that's going to head south, but suddenly Cloughy's 8%, 9% of the high street is actually going to look quite attractive.
It is. I mean, 10-year and 30-year gilts are at like 4.5% and 5.5%. So again, your returns look much better than government debt. Investing in commodities is very risky. Equities, well, FTSE breached 10,000 for the first time, I think, ever recently.
Yeah.
So and everyone's been calling the US equity market as being probably at a top and very AI tech driven and very sort of 2004-5 dot-com bubble-esque feel. Do you invest in equities right now? Probably not. I mean, so where do you go? Well, real estate. It's the safe.
This is the year.
This is the year.
This is it.
Yeah.
There is real value there.
There is
real value.
That's the thing.
It's just difficult value.
And if people can just switch to the other side of caution and that we saw last year, some of these things look like good value.
Yeah, I mean, so people are still paying 4.5% for shops and flats in Knightsbridge. But what's the trend briefly across the sectors? What sort of yield am I expecting on a high street if I'm going to go and buy a £1 million shop in Cheltenham? Are we 8%?
What did we sell in on the promenade in Cheltenham? Mid-7s in the last one.
Decent time, new 5-year lease.
It's average of our lot sizes. But we've been saying it for a while. There's no consistency. You can buy convenience stores. You might sneak into the mid-5s, depending on what it is. Trade counters, late 6s, 7s that we've seen.
But the point is, and we've said this...
Indexation's key in all of that.
We've said it before, that if your investor goes to put £1 million in an asset at 7% in our market, it's 4 checks a year. There's no boiler to break because it's not your boiler. And this might be the year when those yields have gone out. There's a lot of disruption priced into it. 7%, if you're gearing up a bit, turn into a 10% return. It's quite compelling.
And minimal, unlike we were talking about earlier about the capital expenditure required, a lot of that's already been done. A lot of the rents have been rebased in our world. This is old news. And we are starting to see little signs of growth in the better areas of rental growth.
Yeah, but we're talking retail, really.
Retail specifically.
Probably sheds, not as much.
No, but if they're small sheds and they're multi-let, you don't need much growth to make a big difference on those sort of things. So you can drive those on. That's the perfect private buyer acquisition.
Yeah, and it's simple, the simplicity of it.
Has there been looking at the commercial market, and this is a genuine question I don't know the answer to, but the past 5 years, say post-COVID, it's probably had more of a negative impact on the commercial sector than resi. Well, definitely has. Pricing, markets and demand from investors. But is that more the sort of the new order, if you like, in terms of...
You've got two things which go on there.
It was offices, people working at home, then you had retail, then it's online, and you had distribution centre, all that kind of stuff. And it's now just settling down to what's the new norm in the commercial sector.
But you've got two really important things here. You've got the borrowing rate. And all the way through COVID, we give us shoveling money out the door at 1%, 2%. Yeah. That's a very different environment now to 7.5%. So Dunners will tell you can't borrow money better than 7% on commercial.
But what I mean is in terms of the confidence from buyers in the past 5 years, because there's been all this, the retail, high street, what's going on since COVID, back to the office.
But risk-free rates.
Yeah.
Rewarded more doing nothing.
Yeah. Because, I look back at, and I did say this quite a few times at the back end of last year, that I see certainly from the resi point of view, and what I'm interested to know whether it's the same for the commercial, is that I think for a lot of people, 2025 will be the year that got away. What I mean by that is that there were various bumps in the road that actually didn't really turn out to be bumps, and it was waiting for budgets, it was waiting for certain things to happen, and people will look back and go, there was real value there.
They didn't seize the opportunities.
I didn't buy, should have bought, and there were sort of two parts. I'm simplifying it, there's sort of two trains of thought. It's uncertain, the markets are up and down, America in April,
trade tariffs,
Trump, trade tariffs.
There are plenty of excuses for people to take if they wanted to.
The long wait for our autumn statement, all that kind of stuff that happened along the way encouraged a lot of people in our sector, and I guess yours, to do absolutely nothing. Understandably so, I get that. But there were plenty of savvy buyers out there that thought, actually, as a consequence, I've got a market that's been reduced and the pool shallowed out. As a consequence, now's the time to buy. And time will tell if they were right, but it feels like they were right.
We've probably seen a few of the old names come back to the fore when they feel it gets a bit steamy, they just step back. And when they see opportunity, some of the old guard, it predates me, certainly, and your sort of original time, George, that have come back. And they're cash buyers, and they've been sensible. And
I mean, we're dealing with 3 generations of buyers in some cases, in some families. 6 years is a long time, and also overseas money. I picked up on some of the Turkish money this year, is odd in our market. But then there was a Hong Kong guy, who
came and bought some Bishop's Cleeve
office building outside Cheltenham, overlooking the racecourse.
Sorted out finance for him.
Yep,
and
it drove Alex mad for 2 or 3 days, didn't it? But it was a £3 million office that someone from Hong Kong was so keen to get his money in the UK. But he took a short-term debt and he did it.
And I spoke to a regular seller and buyer who's probably been in our world for 10, 12 years. I spoke to him on Monday. This is my year. I've offloaded what I want to last year, sitting on cash. I'm going to go out and start buying. And I want predominantly retail, town centre, big ticket, big lot size. But he's sitting on a lot of money. So my returns are going down. And I think there'll be lots of those
Japan's
people.
Another one. Last year, a couple of Japanese funds bought into London office kit for the first time in a while. And again,
often I don't never see in Japanese.
But they've just their central bank has completely changed its policy now and has raised rates for the first time in decades. It's a complete sea change in their economics. So Japanese money is now exiting Japan a bit more than it used to. So there's quite a lot of stuff going on that is making people look outside their natural boundaries and go, what's the UK looking at doing? Can we actually get better money in the UK?
That's quite a good sign.
Whether that will be in our lot size market, who knows? But it is trickling in from different places.
So, Rich, in terms of buyers, I mean, you talk about Housing Associations 20 and REITs 26%.
Yeah.
Is there any consistency in the buyer?
No, there's not. I mean, and that's where our two sectors will probably always differ. We don't.
I imagine you. I mean, one lot you had 100 registered bidders on last year.
Yeah, well,
you've got an absolute plethora of all sorts of race, colours and creeds and individuals.
Yeah, we do. And again, it's the nature of what we do compared to you is that we will sell things in our catalogues from £10,000 to £8.5, £9 million, £10 million. So it's a real wide selection of buyers and property types as you expect. In terms of answer to your question, what's the buyer profiles? There isn't any consistency there because we're covering the whole of the UK and all those different price points. There's a lot of private investor money, I'd say, going into there. Cash buyers. And to your point earlier on, there are plenty still getting debt. And where we have to be a bit more accommodating is the old notion of a 4-week completion at auction, which is very common still. there are times when we talk to sellers for larger lots or where you've got bulk and volume and they're not in the biggest hurry. You extend those completions out to 5, 6, 7, 8 weeks, whatever it might be, more than we probably ever have done before. And it just helps those buyers. And when you've got a market, which we've all had for 12 months or 24 months, where the buyer pools are shallow, you need to help every single possible buyer to drive that price up.
Yeah, so whilst we joke that you have 10, 20 bidders in auction, for the £2-3 million bottom Marylebone, you're not going to. And I've seen Stuart drive himself mad trying to get completions across the line. But it's important stuff. If the buyer is overseas and he needs another 10 days, it's worth giving them.
It absolutely is, but I think it's critical, and it might be stating the obvious to us, but to the listeners maybe, is that the market knowledge we have comes from really genuinely listening to buyers and their needs and what they're seeing and what their impressions on the market are, and reacting to that and relaying that to the sellers. And we get so much intel from what our buyers are saying to us, whether it be long completions, whether it be that's a good area or that's not a good area.
I would add to that, we also know what to believe.
Yeah, because
we've been doing. I mean, there's a profile of excuses, and some are nonsense, but quite a lot are genuine. And we have the grey hair between. We've all got grey hair to actually understand what's the truth, and therefore you put your shoulder to the wheel and help them.
It is listening to that, and then talking amongst the team as well to make sure we've got consistency there to give them the right advice, and having our finger on the pulse of that is critical, particularly in a tough market.
And on the completions, Cluffy, I mean, we haven't seen. We always say that. It's the unconditional contract. We don't see many not completing. I mean, I can't. There's one last year of the
very few not completing.
They ultimately complete,
and that's because we try to make sure that we do the nuts and bolts and get the detail right from the outset.
You get 10 grand off.
We're taking the bit of security. We're doing the AML up front, and also we have, as Rich is saying, we can talk to these people, and it's not. Sometimes it is a hard stop because that's what it is from the sell side, but a lot of the time it's just being that facilitator. Yes, the contracts have exchanged, but sometimes there are unforeseen things that come up, and it's finding an avenue through that. And it helps the fact that we speak to most of these buyers. Whilst we would class them as new buyers, they don't just come onto our radar on auction day. We've probably spoken to them in the marketing period, so you already have that relationship.
And I've heard you telling buyers, if it's your first time, just watch it. Don't necessarily
and you can. There's a bit of an education piece. In helping these buyers, getting them ready, getting them available, making sure that they know what they're buying, because you'd rather have an informed buyer
and they get to completion and
at £5,000 less than a chancer, if you want to call them that, at £5,000 more. There's no hope of it completing.
And Richard, your completion levels are good.
Yeah, I mean, you asked me that earlier, and I haven't got the actual raw numbers. I can remember in the past 6 months only one that didn't complete, and actually we then sold it. They failed to complete. Deposit was sent to the seller, and we sold to the underbidder for a similar price. So it got across the line. But I think what's interesting, to your point, again, it's always these signs of where the market is that we've got invariably educated vendors more often than not. And they've got something in common, or a few things in common, one of which is we want this to complete. We don't want to go back into auction and save the time. So they'll be a bit more accommodating if and when there are issues
with
completion.
But it's actually, in my experience, it's not a price. It's just another week.
Well, exactly. It's a week or a few days or being tolerant. If you're in a market that's flying, you might find a bit more aggression because you might get a better price in a few months' time. So it's just a sign of the time.
And also, I think linked to that, sometimes solicitors are fantastic when problems crop up after exchange. Sometimes we need to get involved to give more a commercial, let's get the deal done angle, rather than both solicitors standing their ground and there is nowhere to go. So yes, we have been involved in a bit more of that, but that's what we're here to do.
And I think interestingly that our ability to get these completions allows the growth of bigger lots. There's a bigger proportion in our market, and Richard, you've done more bigger lots than ever.
Yeah, we were just short of 100 lots.
What do you mean by big lots? £1 million quid?
Over £1 million quid or more. Last year we were just short of 100 lots that were in that category. I mean, some of them were really, well over £1 million quid. The highest lot we sold last year was just over 8 million quid.
I was there. It was
8.15.
Yeah.
And what are you going to do with it, George?
I watched it. My biggest ever LinkedIn response. I took a picture.
I mean, that was a cracker. I mean, that was Kensington. In the same family ownership for over 100 years. It's the sort of holy grail for auctioneers. It's really virgin stock to the market, hasn't been touched, and all the rest of it. And there was lots of value add opportunities there. So sold well over 8 million, which was great. We sold a partially finished development site that got into receivership in Ealing, and that went out at 5.3. I can go on and on. And there was another one we had in Finsbury Park.
Site, so it's leaking. It's not finished. It's not.
No, they got the concrete's up and the floors up. It hadn't been finished and roofed and whatnot. So it'd been built.
This is your resi development distress.
Yeah.
You know, which has been part of receiverships. Teams,
a
lot of that, and then the buy-to-let portfolio distress.
And is this 100-year new to the first time to the market? 100? Is this generational shift we're seeing in our world, where there is a certain age group that have accumulated over time, and simply the next generation don't want, are not interested?
Fresh view,
and have other ideas, and that's why these assets are being sold.
There's definitely some of that. I referred to it before. The phrase is thrown around called accidental landlords, if you like. You've inherited something, what have you?
It's no longer just granny's flat, is it?
No, and again, it's anecdotal, but we are having conversations with people saying, "Look, I've inherited this, or my wife's got this, or we bought this a few years ago. I don't want to be involved anymore. It looked after itself before. It's not looking after itself now. I've got to get involved. I've got to do this. I don't want to do it." So we are definitely seeing some of that.
Very interesting. I mean, we picked up on this earlier that some of my clients have had for clients for 20 years. Actually, there's 2 family companies just selling it all down. And that's fine, and we're benefiting. But Seb, interestingly, so when we asked you about what the alternatives, you're talking about oil, you probably think about crypto. Now, actually, 20 years ago, when these people were putting their £1 million into a high street shop in Tunbridge Wells, it wasn't easy to invest in oil, in crypto, or in ETFs or anything else. But this new generation, you talk to my kids. I mean,
got your Robin Hood, you got
but my boys are putting £100 into this or that and the other. And it's very different, isn't it?
Yeah, it is. I mean, access to investment products is now through fintech is instant,
and so it gives people choice. But I think what we're seeing is people do understand that long income and the benefit you can gear it up. And it's clean income in the commercial market.
It's almost too easy to go into these other things.
Well, I mean, we can start talking about real estate tokenisation if you want, but that's the next.
You've got another podcast on it. So you gave us some interesting stats on the wider residential market, which I think it looks like these friction costs that the government's imposed are beginning to have an impact.
Probably. I mean, and actually, it's interesting listening to you guys about how you're having to walk buyers through deals more often, and it's not just auctions. I mean, I sit in a lot of the meetings from the other teams as well, and it's been a feature of the last year, if not the last 2 years, for most resi transactional teams, has been having to work harder to get a deal over the line.
And the commercial.
I'm assuming
commercial as well. Alex Butler and you. It's a challenge. Which
is interesting because we've had that decade of cheap, easy debt, which essentially everything was a free hit to a degree. And where, from a resi perspective, it gets very interesting is that whole living spectrum emerged in that free hit period of ultra low debt. Your Excel models for BTR schemes look very different then to now.
200-unit block in Manchester.
Yeah, something like that. I mean,
it was spawned in an era when finance was free.
Yeah.
Suddenly it's 7%.
Suddenly it's now 7%, and some of them have come to or have gone past their sort of initial sort of free debt, funding period, and are now into the kind of normal period of debt costs. And it's no wonder, therefore, we've seen rental growth for the last 2-3 years, because actually it's sort of that market's now growing up into a period of normalcy, whereas it emerged in a period of abnormalcy.
It's evolution.
It is. And that then has an effect on the wider resi market. So there's so much moving in residential at the moment. I mean, it is like a generational period of flux.
In terms of the structure of the market, not the stock?
Well, so stock, the obsolescence point, we're at definitely an inflection point on stock obsolescence, which has been helped and or pushed by government with things like EPC regulation and so on, and then everything that's around that. I think the COVID experience has caused people to reappraise what their homes need to look like and what they're demanding from space. That's also fed, I think, into things like other occupational sectors like office.
Yeah.
If I'm going to come into an office and not sit in my home office, which I made during COVID, or bought out.
It's nearly 5 years.
It is.
It's nearly 6 years.
It is, but it's the new normal.
It is the new normal.
It is the new normal, right?
Markets move.
We've seen it from places like the student sector. Again, students are very much more demanding from the old kit from the 80s, 90s, and so on. Yeah. Is very secondary and tertiary now. Every sector is seeing new demands on occupational space. That's then feeding into price and rental expectations and the cost of developing new kit to meet those new standards.
Yeah.
And resi development, I don't have exact stats, but it's house building is not where the government wants it to be. And it's not even
that is amounting to a lot of
but it's not even being delivered in necessarily the format or places it needs to be. The only thing that stacks up right now is your conventional sort of greenfield Barratt Bellway, 3-4 bed semis and terrace houses on kind of suburban estates. Well, is that actually what we need, or do we need more inner city starter homes, flats and apartments?
Yeah, high rise. It's where we are sitting in King's Cross. It's obvious you can get a lot more units on the ground.
We need first time buyer, kind of younger person accommodation near employment, not necessarily sort of greenfield with a garden and a garage out on the edge of town.
An electric charging point. This doesn't.
But you can't build it now. You can't build it in this because of building safety, post Grenfell fire regulations, cost of development, high rise.
But we haven't seen a shift in demand to support that, have we? Or have we?
Well, we're not in the build to sell market. The average prices for apartments have been moribund now for a few years, and it's the viability on developing new build apartment stock is so poor in most urban cities that the game's not worth the candle, which is why it's not getting delivered. And there's no demand side incentive or help from government yet.
But one of the reasons I asked that is that, and again, it's anecdotal from the volumes that we see, which is reasonably high volumes, is that the sale of flats in cities is very challenging because of your service charge costs, and they've gone up exponentially the past few years, and various other matters as well. That has made it much harder from an investment point of view, and I assume the same applies to the end user market, that people are maybe looking further out or looking to get freehold and to do that.
They might be waiting. I mean, there's been a very high-profile campaign against the merits of leasehold. So the government is actively looking to change it to common hold now, and not just for new build.
But that won't get away from the service charges, though.
You still got lift on the bids collected.
Well, this is the question. So common hold will be coming in at some point in the next 5 years. Right, it'll start with new build flats first, and then it'll be rolled into existing leases. But no one knows really what the cost of running a common hold is yet, or what a common hold association agreement looks like, or what you'll have to do to run one. So I think there's a bit of we don't like leasehold. We've been told it's not great. We've seen through the service charge experiments and stuff that it's costly. We don't yet know what the future looks like in this space.
So there's a lot of battle still to be had over that.
But it's rebranding, isn't it?
It's
uncertainty.
Yeah, it costs to decorate the common parts and to collect the bins and all that.
It does.
It's an important step.
But if you're a developer of new build flats in an urban centre, do you want to be the first one putting a new common hold scheme up?
You probably don't.
And market test it? I don't know. I mean, it's so there's so much happening in resi that is all shifting, and then you stick in planning changes, the planning reform at the back end. It's a lot of
particularly exposed to planning in our two sectors, but boy, I've got a bit of private exposure. It's just hard.
Everything is moving at the same time in residential, and it's big movements, and it affects the volume of property more than commercial, which is a couple of million addresses in the country compared to 25 million odd resis. Yeah. So so much is moving that I think that's one of the reasons why people look at it and go, well, do I invest in residential? There's so much moving right now.
Yeah,
I think there is a massive pot of ex-buy-to-let money, for example, that we don't know where it's going or gone.
Well, hopefully we'll tell you on February the
9th. But I do agree with that in principle, and I was very surprised how well we did last year. Yes, we've got the sellers, and the sellers want to sell. That's fine. But we were finding the buyers, and our biggest and most successful auction last year was the December auction, a week before Christmas, of £70 million. Now, that came a week or so, or less than a week after interest rates came down. And I don't think,
Rich, and you got the budget was in print. I think there is pent up demand.
Yeah.
I think
exactly that.
And they thought, okay, the budget wasn't so bad. The income tax increase and everything else on rental income, but it was out of the way.
And then interest rates came down, and actually the direction of travel
inflation looked a bit kinder. Yeah. Interest rates came down, so suddenly, and they responded. That's how quick our market responds.
But that's to my point, is that there are now, and we saw it. We saw more buyers and bidders registering for the auction in December compared to September, October, November, which are the uncertain times running up to the budget and post-budget. So when we go to the predictions for next year, it's not a big prediction, but we are seeing more buyers coming back to the market who are those that were understandably sitting on their hands for the last 6 months, 3 months, whatever it is. And that can only be a good thing because inflation's coming down, interest rates have come down, budget's out the way. There are things... Granted, there's going to be some bumps in the road which Trump will create, or it might be,
maybe as well an agreement.
But those economic points that have been holding the market up a little bit, or certainly for some buyers,
by holding it up, you mean slowing it down.
Slowing it down, yeah.
And that's I think it's exactly the same message from the commercial side. Is that we are optimistic about where we are going forwards. We think there are going to be those cautious buyers that get off the fence and start moving forwards. And I think there will be people that become more motivated to sell as well.
Yeah. And if those legacy valuations maybe getting the right level for the market, they can get rid of that stock and then go and reinvest if they want
across all sectors of sellers as well.
Yeah. And I say that about the fund market. There's in legacy valuations are a challenge, but they're slowly being eked out, which will free up capital and activity.
And there'll still be a polarised view on certain properties and certain asset classes, and always will be.
So we need to wrap up because we've held the list for quite a while. So Clough is positive but this year because the time's going to come. Bit of pent up demand.
I think so, and I think we're well positioned, and I think it's quite exciting to see. Of course, it's not going to be plain sailing. We know that, but I think it's quite exciting to sort of turn the page and look forward now with things trending in the right direction for both buyers and sellers.
Yeah. And Rich, you'd agree with that?
Yeah, I do. I think it's always hard to crystal ball gaze in any market, and the auctions are no different. You go month to month, and that's as far as you look ahead, really, like on a foggy day. But I see that we're going to have probably, certainly for the next 4 months, if not the first 6 months of this year, similar volume levels.
Volumes, yeah.
And I'm expecting more buyers, and the more buyers is more competitive tension,
Can
better
I ask
prices.
you just not to be too greedy, because 100 people registering on one lot is too many, all right?
It is, yeah, I know. We'll share it around.
Seb, predictions? Before we ask you all, where would you invest £5 million, Seb?
I think it's a gentle acceleration of the trends from last year in most directions.
It's not a boomerang response.
No, barring any, black swan events. Yeah, it's more of the same of last year in all directions, really. So economically it should improve. Okay. And I think we should see the optimism and sentiment improve this year.
And rates are coming down.
Rates are coming
Pretty
down.
much, Gareth set in. Question from when.
Yeah.
So £5 million of medium-term money to invest, William Clough. Where would you put it?
I can't work out which hat I've got on today. And there are a couple of buyers in our market that I look at and I like what they do. But one is high volume, low value, high yielding, and spread that risk with the knowledge.
Shop in Grimsby.
With the knowledge that some of them will fail, but not many of them. I've got I will go long and boring with a nursery or a C-store indexation.
Because you've got RPI, you've got long leases, the tenants fitted it up.
And exactly, and there's high fit out costs on the nursery side of things as well, and it is a hugely popular sector. Yep. There's some big name tenants out there. I still like a bit of roadside.
You quite agree. You got it at 10 million. We stuck it at 5. But you like
it depends what lot size you go. You can buy
£2.5 million.
Exactly.
And drive in a charge point or two.
Yeah, and that's the thing. The other thing I was thinking about, would it be some sort of open land like Alex's Dunstable thing, where there are options for income generation, be it charging, be it storage, be it things like that, not income producing initially.
Yeah, so I think you should be a politician because you haven't really committed anything.
And I've got a real urge to buy.
Too good to be a politician.
I've got a real urge to buy a big city or town centre old department store or something like that.
Because at 20-30 quid a foot,
because it's
got
just extraordinarily cheap on capital rate.
And we haven't covered that. The demand for these vacant buildings, the old banks, is actually surprising us. So year in, year out, it's there. We sold a lot of them in 2004, and they're coming back, and we're selling them, which is good.
So I've given you lots of ideas, but there are a few things depending on what price point these things are.
What are you doing with the department store? Repurposing to resi or reletting and refurbing?
I think there's always going to be the angle of repurposing upstairs if you can get through the planning obstacles that we've discussed. And then I'm going to set up my own operating company downstairs.
Okay, fantastic. Rich?
I'm going to be just about as slippery as you there. I'm going to say I said it last year, I think, and a few podcasts in the past. I still think, maybe sadly, that there's obviously a lot of need in the country now, and more so than ever, for supported housing, supported living, HMOs, sheltered accommodation, that kind of stuff. And I think there's a lot of that kind of stuff coming to the market where existing landlords...
There's a lot of buyers for it.
A lot of buyers for it, but a lot of sellers for it at the moment, which we will see for sure in the next 6 months in our catalogues, where they need upgrading. And I think there's some opportunity if you invest in those areas, similar to what you're saying, in some low-value areas and buy in bulk, because there's a lot of demand from local authorities for that accommodation if you get it right.
Every dozen units you get puts the management cost of your existing 100 units down. It just brings it down.
But it does, but there are operators out there where you can get a 5-10 year lease or 3-year lease to an agent who'll let it, and you can sit back on it as passive income. You will have some capex to spend on it, but I think there's some real value there in terms of bricks and mortar values. They're low. You can't build for that. And if you spend a bit of money, get a 3-5 year lease on it, or even manage it yourself.
So you're trying to deliver the clean return that we can offer in our commercial.
Exactly. And it's not as secure as that, but I think that's definitely an opportunity because that stock will be coming to the market, and sadly there's a real need for that housing, and there's a shortage of it. The second thing, generally, I still think London's undervalued for resi. It has been. It hasn't been creeping up or flying up as it has been over the past decade or so. There's still some value there.
You buying vacant London or investment stock London?
Well, there's a question in that as well, is that I see investors that buy from us prefer to buy vacant so they can actually vet and choose their own tenants. Inheriting tenants when it's hard to get tenants out is a bit more challenging.
We haven't managed to rent a reform bill, but we haven't got time.
No, and the third thing I'd say, it's just more commercial, is I would love to buy a golf driving range because... I'm not speaking
because you spend so much money on them.
So much money on them, and I can't get into them. You go down there, and there's queues. There's ticket queues like you get at the cheese counter at Waitrose. At any driving range you go to, any time of day.
Let's go see your weekend plans here. The cheese counter at Waitrose up to the driving range.
It does say a lot about it, but it is. I mean, if you can buy a driving range...
So you've listened to a lot of wittering and politically non-committal answers. What would you do with £5 million in the property market?
If you ended a 0-2, I'd be doing new build development in London because of that, where we are in that cycle and how much is currently...
haven't added it.
I know you haven't, I know. So I can't do London. I think I'd be targeting no frills, highly affordable sort of communal living spaces in towns that have got a high number of HMOs, high proportion of students in the mainstream PRS, because that stock's falling away just from an obsolescence point of view. There's not enough PBSA.
This is your thing, isn't it? So get the tenants out the really tired stuff and put it into your own.
Yeah, and I think so. It's not really co-live, because that implies amenitized and a certain sort of number of units. But I think small scale, highly affordable, easy HMOs at the risk of giving plug to Stelios, but really affordable rental, because that's where the pressure point is. The iceberg is melting away sort of under the waterline, not the prime stuff above it. So if you can find affordable rental kit in a building you manage, and I think you probably can get away with doing that for 5 million, your Coventry.
And your yields are pretty strong.
Exactly, and your Coventry's Nottingham's.
It feels like rental growth is out of it.
It's inevitable based on supply-demand picture, unless the government turns on a help-to-buy style tap to take tenant demand out of rental.
There's a lot of that secondary and tertiary 10, 15-year-old student buildings. What we've been selling last year and we're selling this year, which actually are perfect for that kind of stuff.
And they are. To the scale for those as professional PBSA, it doesn't really work anymore.
Not anymore, no.
But your local, regional
exactly
property company can do that.
Can repurpose it and do that. When we sold quite a few last year, Coventry, really Birmingham, a few million quid, there's more of that coming as well.
Well, thank you, everybody. Our panel for some really interesting and pithy chat today. We're trying to put this in writing. We have put it in writing, and it'll be published next week, both outlooks for the residential and commercial market, available on our website, allsop.co.uk. Look at insights, that's where you'll find them. Any direct feedback, that'd be lovely too. George.Walker or Will.Clough, Rich.Adamson or Seb.Verity at allsop.co.uk. And next time I really will talk slower. Thank you, everybody.
Thanks, George.
Thanks, George.